Hi, wanted to ask you the question. What really affects mortgage rates? Well, let's do two categories. One is the borrower specific, which is you or me trying to get money from the bank. And second is the market conditions. So your credit score, the higher credit score, the lower the risk, more than likely, the lower the interest rate. How much are you going to put down? What's your loan to value? So depending on how much you put down, obviously the more money you put down, that means the bank feels there's less risk, lower loan to value, which means more than likely a lower interest rate. But what about your debt to income? Well, your debt to income is how much money you make and how much money you owe. So we include the minimum payment of the credit cards, if you have a car note, and then your new mortgage, add that all together, and then that lets us know what your debt to income ratio is. And depending on the loan amount, and your loan terms will then dictate, right, what your interest rate's going to be, right? So obviously, the larger the loan amount, more than likely the higher the interest rate, higher risk. The longer terms, right? We do 30-year fixed, but there are 15-year loans, believe it or not. Obviously, your mortgage payment will be higher, but something we could talk about should you want. The other thing has to do with what type of loan are you going to have? Is it a purchase? Is it a refinance? Is it a fix? Is it adjustable? And how will this impact your rate? Well, if it's a purchase, right? You got conventional FHA, VA. You also have USDA. And based on that loan amount, again, how much you're going to put down, your debt to income, all of that plays into the risk that the bank has. Refinance, you've been in the home, you're taking out cash. Are you going to just refinance your first? A lot of us have great rates, so a lot of us are doing what? Or considering doing a second equity line of credit or a HE loan, which is fixed. Okay. Again, the lower the risk for the bank, obviously, the better interest rate you're going to get. But really, the biggest thing that actually affects our mortgage rates is the economic conditions. As we know in this administration right now, we have the tariffs, right? We have inflation. The Fed said, hey, maybe I'll reduce the rate. Maybe I won't. But remember, that's the Fed fund rate. So again, inflation, employment, that is the biggest thing that affects it. I know I did a video in regards to bond market. So if you use the 10-year treasury bond, that can hold as a benchmark. So I think it's 4.59 today. It keeps changing. Add 2+%, and that gives you a baseline, a benchmark of what the interest rate could be for you. And again, it depends on the market rate, when you actually lock the rate, how much you're putting down, credit scores, and things like that. Mortgage-backed securities. Well, what are those? Well, that also helps us with what's going on with the bond market because most banks group all their loans together and they sell it to the secondary market, right? So let's say I have $1 million to borrow to people. If I use up all that $1 million, I don't have enough money to then do more loans. So I have to decide on my portfolio how much I'm going to keep and how much I'm going to put into mortgage-backed securities. Then those get purchased out, and then that too affects what's going on with the market. But overall, mortgage rates are a combination of overall, mostly the economy, right? Because when we're doing rates in the twos and the threes, that was more the economy. Then it had to do with you as an individual, how much money you're putting down, what your credit scores are. Any other questions or concerns, feel free to give me a call, 619-846-2675.